Welcome back. My guest today is Dave Kotter with Integrity Capital. Our objective today is not to give financial advice, but to educate listeners about bridge loan investing as a passive investment class. We always encourage that you meet with your financial advisor or CPA before you make any final decisions. Dave Kotter, welcome. Thanks for coming.
Thanks for having me here, Doug. I appreciate it.
Absolutely. Well, we certainly want to get some of this information that you have on bridge loan investing. But before we jump into the investment aspect, maybe break down what bridge loans are, what they're used for, and why do they exist?
Yeah, bridge lending, as I define it, is what I would consider transitionary lending. So you have your construction loan, you have a bridge loan, and then you have a permanent loan. And so that's that in-between lending that happens in the industry. So sometimes banks will do it, sometimes debt funds will do it. But the idea is whether you're coming out of construction, you're not quite leased up, that's one situation that a bridge loan will be utilized. Or you might actually buy a dilapidated property that was mismanaged. You're going to turn it around. You need a bridge loan because there might not be debt service coverage yet on the property. And so it'll do a 2 to 3 year is typical for bridge loans. And they'll usually be a little bit more open to risk. So that's why people utilize it. And that's what I would consider a bridge.
So would it be kind of a step above hard money loans, private financing?
Yeah, I would say that, there's a couple of different buckets. So if you look at hard money loans, usually the mentality of those individuals are, I don't really care about you per se. I just want to know a couple things. What is the property worth to me? And I'm going to lend you 50, 65% of whatever I believe that value is. And I'm going to charge you a really high rate because I have to close fast or there's some unforeseen circumstance that would make you get a hard money loan, which again is more expensive, like 10, 12, 13%. And you'll pay 2 to 3 points. Usually people do that because, again, timelines, some sort of constraint, some issue that's going on with your credit. A bridge loan, I think, is different in the sense this is probably more of a qualified person that just happens to be buying something that can't go get a permanent loan because it doesn't really have cash flow. There's some reason why there's an issue with it, and they feel confident that they can add enough value to lift it and get it taken out. So, that would be a debt fund that would do something like that, and they're going to probably charge anywhere from SOFR plus, on the low side, if it's a multifamily deal, might be 250 to 300 all the way up to SOFR plus 600. Usually is the pricing. So SOFR today is 366. So just add that on top of it. You're going to be anywhere from 7.5 up to 9.5 kind of range. Generally speaking, they're going to be non-recourse. So nobody has to sign personal guarantees with some sort of carve-out provision. But I would consider those their own class outside of a hard money loan.
Understood. Okay. And when you say SOFR, you're talking about what exactly?
Yeah, so SOFR is an index. So if you think about different indexes that lenders use in order to price their specific instruments. So for example, if I'm a lender doing a permanent loan, I might use a 5-year treasury as my index. And then I'm going to add a spread on top of that because that's the profit for them. So SOFR is its own index. It used to be a swap rate, now it's SOFR. It's kind of the overnight Fed rate is what they consider it. And so that changes every day. Today it's around 3.66%, but you can actually go on and see that index. And then the lender will add a spread on top of that, and then it's just going to float with SOFR. So that might adjust every month depending on the payment. And so SOFR is the index they'll use in order to price it. And again, most lenders will price risk pricing. So if it's a tertiary market, so smaller market, like if you're, for example, I'm up in Lolomai. So if you're in Lolomai, it's a smaller market. Someone's probably going to price higher because there's not as much activity up here as opposed to if you were in Phoenix Metro, which is a larger market. And so that's how bridge lenders will price. The majority of them will do that, or they might use Prime. Prime is another index that you'll see. It's probably more popular for the average person, where, when you hear the Fed is going in to change rates, typically you're going to see that rate, which today is 6.75, and they might go, we're going to bump that 25 basis points. So those are the indexes that are used for bridge lending as well. And then typically you're going to borrow. So let's say if someone's doing a project for $5 million, they might go in and actually spend money. So if someone in your audience was buying an apartment complex for $5 million and they're going to spend another, call it $1 million of renovations. So they're going to go in and they're going to, paint and redo some plumbing and, fix the outside landscaping, all those renovations that are going to take place. And then we have a $6 million budget. So that $6 million budget is your total cost. So that's the number that they're looking at. And what they'll also do inside of the budget, it's not just renovations, but they'll also say, well, by the way, you don't have enough income on the property in order to make the debt payments. And everybody kind of goes, well, that could be a problem. Not necessarily for the bridge lender. What they do is they add into the line item of the budget some additional interest payments that will help the developer to actually make payments until such a time that they actually get income that's sufficient enough to cover the debt payments that the lender is going to charge. So those are the kinds of things that go into a budget when you're trying to figure out, I'm going to go do a bridge loan. You need to look at your total budget and include those things. Hard costs of things you're physically going to do to the property. Soft costs like legal or architecture or any other things that are not hard costs. And then you're going to include interest payments in there and a contingency, because things never go as planned, as you well know. And so we'll have contingency in there. So that's how you get to a total budget on a bridge loan. And then they will lend usually 65 to 75% of the total cost.
If you're like many of my clients who've owned rental properties and apartment buildings for 5, 10, 15, 20 years, you're most likely tired. Maybe you're tired of the tenants. Maybe you're tired of the telephone calls, the toilets, the turnover, the terrible teas. And what you're looking for is maybe a little more time off, a little more travel, a little more tranquility. That's why we've created the new webinar, Mastering the Exit. Sell your rentals, defer your taxes, and reinvest into passive income streams. Spend 60 minutes with us as we cover going into a 1031 exchange and looking into more passive options. Maybe you're looking to reinvest into a net lease asset, or you're interested in a Delaware Statutory Trust or DST, or maybe you have a favorite charity and you want to learn more about the Charitable Remainder Trust. Register for this free webinar, learn more about what your options are so you can get away from the terrible T's and focus more on the terrific T's. Understood. So you have an investor who's looking at an asset, let's call it apartment buildings to keep it simple. It's a value add opportunity. They feel like they can go in there, do some turnaround management over a course of 12 to 36 months. And what they need is to cover that gap in order to cover all those costs that are going to be involved in that. So you guys are lending up to a certain amount of the cost, a percentage of the cost is 65%. However, you're not going overboard so that when that property is repositioned, the rents go up, income goes up, expenses go down, they're at a higher valuation, then they go and get permanent financing, probably from a traditional institution, pay you guys off, and they're on their way. Is that generally how it works?
100%. Henceforth, the bridge.
Okay.
We're going to help you go from here to here, and then we want to get taken out of the deal. And that's the idea behind a bridge loan is you've done enough due diligence and you believe as the person buying it that someone has mismanaged the expenses. That's one of the things that could have happened. It's just, in fact, I'm looking at a deal right now where taxes are too high because they didn't go in and contest it. The insurance is way too high. The property management fee. So they can cut expenses. That's one of the things they can do to add value. But then they know they can renovate units. X amount of them are down. Or they can turn them over and they know they can spend $5,000 a unit and lift it by $100 or so. And so that's part of their job is like, do I feel like I can turn this thing over and really lift it up to where now the income is another $250,000 than it was before? Well, all of a sudden, when you take a cap rate, after that, the valuation just went up $2 million. It's like, great, good move. And then they can go ahead and probably take out their existing loan. A lot of people will then do what they call a refinance strategy, where they'll go refinance out and they'll get back anywhere from 85 to 100% of their original equity in there. So not only do they get the debt taken out, but they get all that equity back to their investors. So now their investors got all their money back, but they still are in the deal and they're going to get the income. And so that's the beauty of a bridge loan, is designed to help somebody go through that transitionary period for them to eventually sell it or roll it up into a permanent deal if they want to keep it. And so each one of those are strategies that people utilize in order to have success.
Understood. So with Accredited Capital, you guys are actually out there on the hunt for twofold. You're looking for opportunities to provide bridge lending for, and you're probably also looking for investors who want to invest in these bridge loan opportunities. Why would an investor choose investing in, say, bridge debt instead of, say, investing directly into a syndication? What would be the difference there for an investor?
Yeah, there's a couple of reasons why. I mean, when you're an investor, you have a couple of different options, right? You either go to your wealth planner and you're going to go into stocks and bonds or traditional ETFs. That's one thing, and it's good. That is a good way to do it. It's more passive. You're just kind of diving into a large bucket of stuff. Or you can go into an equity pool. So when you go into an equity pool, what ends up happening is you are now jumping into a equity position with that particular GP. So that general partner, who is the person that's buying the property, they have the expertise and the experience, and they're the person who's going to actually run, manage, renovate, and then sell or refinance that property. You might come into their limited partnership, so you're passive, and you're in this bucket of, equity that has the capability to do very, very well. And so that's one way to go. The challenge with that too is it also can go way the other direction, meaning that you're the first person to get wiped out because the person that's the lender is the first one to have their preservation of the position. So the reason why we like what we do is because we're lending the money. We're not in the limited partnership. We're actually lending money to those sponsors. And we are in a position where, for whatever reason, God forbid, something happens, we can actually foreclose and take over the asset and preserve the capital that we have in there. So people come into instruments like ours, and ours is a little bit unique because we have an extra little component to it. But first of all, they know that there is downside protection of a deed of trust. So we're in first position. That means that we can foreclose on the asset. That preserves somebody's position as the first person to protect the capital. The second reason is because you have ongoing income. So as opposed to the general partner that's doing the acquisition and the renovation, which again is wonderful, but they may not have income for 12, 24 months. So there really is payments that they might be accruing to pay you, but chances are they're not actually paying you day one. With what we do, there's income right out of the gate. And so people get payments every quarter, and we pull that money aside, and it's already set aside to make payments. So we're not like hoping that we're going to get the payments, they're there. And we already reserve for that up front. So that's the second reason people like that. And then we do all this due diligence and underwriting and all these things that go into it to make sure we think the sponsor really is good, the borrower. We think that they've done this before and have a track record. They've got a good character and a reputation. And so all these things we go through in order to make us feel like, okay, we know we can get in, get through, and get out of it. That's all we're concerned about. We're not trying to make a home run. What makes ours a little bit different, which people kind of cock their head and go, that's interesting, is we have upside participation. So what'll happen is people come in, not only do they get the downside protection, the ongoing income, but then they also get a second bite of the apple, because we go a little bit higher on the loan to value than the next bridge lender. But in exchange for that, we're taking 25 to potentially 50% of the profit with the developer. And we're not in their limited partnership, but we get additional interest in that participation when they sell it and the income. So that's why people like to come into these types of things, because of those risk adjustments. We're kind of in that middle tranche, so to speak, if that makes sense.
It does. So primarily, just to recap, because I think you gave us 4 positives there. Primarily, if you are directly invested with the GP into the asset itself, God forbid things go sideways, they get foreclosed on, well, you lose everything as an LP invested in that property. However, if you're invested as the lender, you're the one, again, God forbid, that's doing the foreclosing. So not all is lost there. Secondly, you are able to capitalize on day one returns, day one dividends, because you're not waiting for the buildup of the property to get it leased back up. And I could certainly understand that. And then third, you guys add an additional bonus that we won't go too deep into detail. What I'm going to do is provide contact information for you down below. So if anybody who's looking to get into the weeds, for instance, rates of return, things of that nature, some of the bonuses of going with your company versus the other guy, definitely we're going to encourage them to reach out to you directly. But as I understand it, those first 2 are the main benefits. Number 1 is you're the lender, you're in first position on title, which means you get paid back if something goes sideways for the most part. And then secondly, which is actually a pretty positive one, is day one returns.
That's correct.
Got it. Understood.
There's day one returns and then the upside participation. So again, the reason, and these are all considered alternative investments, just like if you went into a private equity real estate deal. And again, people need to do their homework. We do a lot of homework when we look at projects, because we really want to make sure that we have at least 2 ways to get out of the deal: a sale, a refinance. There's a way that, and again, for us personally, we just look at it and go, if we had to foreclose, not that we ever want to, and that's a rare occurrence, but it can happen, that would we be okay and happy to own this asset? I mean, that's a question you have to ask yourself. Do I feel like I'm lending on something that I just would never even want to own? So that's part of the due diligence, is if we believe that's a great market and a great asset.
On that note, you're out there, like I said, looking for opportunities. Do you generally have a decent offering of opportunities, or in this current market, is it one opportunity available usually at a time, and you're just moving on, looking for additional opportunities on an ongoing basis?
Yeah, I would say we look at a fair amount of deals. Uh, Obviously, we're always looking for more, but we do see quite a bit. And we're in a market right now where there is a high need for bridge opportunities. And the reason why is, as you well know, back in 2022, when the interest rates jacked up, all these people that were apartment syndicating unfortunately just got into trouble because now those floating rates went up probably 3x, and they lost their interest reserve, and people are in a position where they're having to liquidate assets. So it's a time right now where people are scrambling, trying to figure out how do we, it's not the optimal time to sell an asset. So they're saying, how do
Right.
we give ourselves more time to do deals? So bridge lending is ever present right now. And I think that'll continue for at least the next year. And so I would just say that ultimately that is something that people are really looking for right now. And again, what makes us unique is people are having a hard time. The biggest issue people have right now, period, is raising equity. Like, that is the number one challenge. Everyone from the small syndicator all to the institutional person. It's the Achilles heel. And so what we do is we basically take that off of the sponsor's plate by doing a more stretch senior type of situation, because that is the challenge. You talk to any person, they're like, raising equity is my biggest problem right now. And so if you can help kind of solve through some sort of bridge instrument, then people are just eating it up right now. That'll change eventually, but for now, that is the number one issue that people are running.
Interesting. I didn't really think about how a bridge loan could apply to the current challenges that a lot of the owners, like you mentioned, apartment owners are facing with debt refinances that are debts that's coming due. All the
Yep.
3, 5, 7, and 10 year deals. Plus, with insurance rates going up, so you guys are able to give them some breathing room to get their house in order so that they can reorganize, restructure, reposition the property if they have to. So that's giving you more opportunity in today's market.
Yeah, there's a couple of scenarios. Number one is somebody went in and built a apartment complex. I'm just using that for the sake of discussion. So they built an apartment complex. They had a strategy. It was a merchant strategy where they were going to go in and build it, lease it up, and sell it. What has happened is, because of the current environment, because there was a saturation, oversupply of apartments built, then you have this kind of trifecta thing where it's like, oh, we have to give concessions because there's too many properties. Oh, interest rates just went up, so now my underwriting just changed dramatically. And oh, by the way, I can't go get more equity. So they're just stuck in this weird spot where it's not a good time to sell. Cap rates have gone up, which means your valuations have gone down. So people are saying, gosh, how can we just wait this out for another 2 years? So they're utilizing bridge loans to come out of construction and just wait it out for a while and kick the can down the road. That is a very live scenario that's happening for people right now. And the other one is, people are coming up on balloons, and it might have penciled just fine and they could have gotten a normal permanent loan, but now because the rates are higher, they're like, crap, I can't go get even my proceeds. So they're using bridge loans at interest only as opposed to principal and interest in order to bridge the gap on that for a while till things settle down. And you've got about $1 trillion coming due in 2026 and 2027. So tons of that is happening right now where people are stuck because the rates have gone, they had 3%, 3.5% rates. And now they're having to go, oh my gosh, I got to be at 6.25. That doesn't work. I just doubled my interest rate. So that's a fundamental issue that's happening right now that people are trying to figure out, or they have to come in with additional equity in order to buy down the loan. So that's a real fundamental problem that people are facing today, right now. And then the third one is the people that are in position to capitalize on unfortunate situations. They're buying deals. The guy that I'm working with right now is buying one that, it was an unfortunate situation with the family, and he's picking it up for a very low price per door. And he's going to turn it around and, again, lift the rents, fill it up, spend some money, and then exit. So the people those are generally the three scenarios where a bridge loan is very, very favorable to individuals right now. And those are the most likely scenarios that are taking place.
Yeah, I definitely can see how the next 2 to 3 years, or 1 to 3 years, are going to be interesting. Not only is the debt coming due, the balloons are coming due, but also, a lot of folks are getting older. A lot of our clients are getting older, and their kids are inheriting property. So there's a lot of that, the silver tsunami. So it's definitely interesting times to be in business. Okay, so we've talked about the positives for investors and invest passively into bridge lending. What are some of the risks that they might be taking by investing in bridge? If someone defaults, how is it handled for the investors who are investing with, say, a company like yours?
So just for clarity, the people that would come in and invest with us to lend the money, is that correct?
Correct, yeah. The investors that would be lending the money, investing with you guys to lend the money out to the borrowers.
Yeah, there's a couple of different scenarios. Number one is, market shifts, things go bad, and all of a sudden these properties are not worth what they are. Someone just finally kind of raises their hand. Person might be in a position where all of a sudden it's like, okay, we're going to have to basically look at the valuation of this asset where we thought we were going to get better upside. That may not be the case. So we have to foreclose or just liquidate the asset and get the money back. So there is chances are that, someone's not going to make the returns that they thought they were going to make. So it might be a more unfavorable situation for investors. That is a potential thing that could happen if all of a sudden the market goes bad or we have another COVID or whatever those things are. So somebody in that position all of a sudden is like, oh gosh, could be in a couple of those assets, takes longer to work through it. And so all of a sudden you thought you were going to be in this thing for 2 to 3 years, might turn into 4 or 5. So that all of a sudden the money's tied up a little bit longer than you thought. That is a potential scenario that could happen. I would say the third one is, again, if we had to foreclose on the asset, now we own the asset, we have to go through, spend some dollars, turn around and then sell it, right, to get our principal back. So the most likely scenarios are things like that where the risks are, market timing. If all of a sudden we were lending back, which we weren't, if we were lending back in 2019, we'd be at the height, right? All of a sudden we were lending at the most premium time of asset valuations. So all of a sudden if those values go down, which they have, that could potentially eat into principal of the loan balance. So there is a possibility that someone could lose part of their principal. So they might have been getting payments, might be getting their returns, but all of a sudden they might get a little bit of the principal shaved off. Again, what we love about it is you're not like an equity person, it's all gone because you're at the top of the stack. But that is a potential. That is part of the risk that could happen as an investor that comes into these types of things. So those are the more likely scenarios that could happen.
Certainly risk. Are you requiring folks to be accredited investors in order to invest, or is it open to generally anyone?
Yeah, you have to be accredited investor, which again, these definitions change over time. But $1 million net worth outside of your individual residence, and then I think if you're an individual, you have to make $250,000 for the last 2 years as a household for your adjusted gross income. Is what quantifies or qualifies somebody to be able to come in as an accredited investor. Because again, this is more sophisticated. There's more thought. You're reading through documents. You're having to understand things. So we are, for our fund specific, we need people to be accredited investors. We have a mandate for that from the way that we're set up. And again, we don't mind educating and helping people through it. That's part of it. But it has to make sense, and someone has to really understand what they're getting into. And so therefore the SEC mandates somebody has to be an accredited investor.
Understood. This is a good time for us to always give that disclaimer. This isn't investment advice, folks. We always recommend that you meet with your certified financial advisors, your CPA, your tax preparer before you make any of these types of investments. On that note, what kind of investment are you looking for from the average investor? I mean, is there a kind of a dollar amount that is the typical of bridge loan investing as a passive investment asset?
Usually the minimum for us is $50,000, and I would say a normal investment is going to be $100,000 to $150,000. So that's typically what we're looking for from somebody. And again, in our particular instrument, there's different types of funds that you go in when someone's making a decision. They can go into what's called an open-ended fund, which means that you can come in and out of it in a fairly short period of time, which means it's technically more liquid. Or you can go into what's called a closed-end fund, which is more non-liquid, which means that you really can't pull your money out for a period of time. For us, because of what we do and the length and breadth of instruments we're involved in, we're more of a closed-end fund, more non-liquid. So people would come in, they would be in our specific fund for probably about 5 years. We believe they'll get really great returns, but again, it's not as liquid as an open-ended fund, or even obviously a lot less liquid than if you're dealing with ETFs or just the general stock market, because it's just a fluid, liquid market. So that's the way we approach it.
Understood. So if someone invests into a bridge loan, they're looking to probably have their money in that bridge loan for about 5 years. And now, how do you invest? Now, I'm assuming that you cannot do a 1031 exchange out of real estate into a bridge loan, or can you?
You cannot. We've looked at that before. I mean, you could. You're going to get taxed. You can put your money in, but you're still going to pay tax.
Sure.
I believe there are one or two instruments that are out there that you can go into a 1031, and it's more of a REIT pool that you can go into. But for our particular fund, you can't 1031 exchange into it. It is a taxable vehicle that we have. Again, we have really good returns and they're very risk adjusted. The challenge for some people that are very tax motivated is we're not a tax, advantaged fund. So we don't have depreciation, we don't get capital gains. They'll treat like ordinary income because we intentionally did not want to go into the limited partnership. The returns are pretty high, but we didn't want to take that additional risk. So that's what people have to think through when they're going into it is, do I want better returns, but I'm less liquid? Looking at the tax component as well, and, risk. Because that's what I always tell people. I said, look, every deal's relative. You're like, I'm making returns of this over here. And I'm like, well, but what's the risk? It's not just I'm making these returns. It's always risk adjusted returns. You have to think about that, whether you go in the stock market, what's the risk you're taking, and then what are the returns? you have to look at both of those when you make a decision of going into any instrument. And so you need to be proactive about that.
Now, what about using, say, a self-directed IRA? Could an individual use a self-directed IRA to invest into your fund?
Absolutely, they can. What they would do is they would work through a trust administrator who's set up for doing those, and there's many of them out there. There's a couple that we work with that we make recommendations to that we feel are very sophisticated, detail-oriented, and really have the track record to do it. But there's some nominal fee that you pay. But a lot of people who don't really know about self-directed IRA investing, it's something you should, because there's so many advantages to taking that money that's in there and investing that into an instrument. There's a lot of tax benefits that people can get. And so we do take self-directed IRA money, and it's something that we're going to be doing more and more education around with some of the partners we work with, because we feel like it's an untapped market that people just aren't even aware of. And obviously you need to be educated about it, but it's a great way to basically optimize taxes and optimize money that's sitting there that you can really take advantage of.
Absolutely. I mean, this is actually quite interesting, because I never really thought about bridge investing as a passive investment class until I met you. Of course, there's always been hard money lending, and a lot of folks use their self-directed IRAs to invest in hard money, but going in this direction is another solid option. As we wrap up, again, we're going to put all your contact information, Dave, down in the comments below so people can reach out to you directly to your website. As we wrap up, what are some of the questions that people have, that investors have, that that we haven't covered yet, that you find yourself explaining over and over again about your business model and how they can invest in it and make money?
Yeah, I think there's a couple of things that people want to understand about our particular instrument, and it's how does this really work? Because we're so unique, because we're not just lending money and getting a coupon, but we're getting upside participation. They always really want to understand, how does that work? Are you a mezzanine loan? Are you a pref equity loan? And the answer is no. We're our own class. We have a first deed of trust. We get the income just like anybody else would. The difference is we're getting upside like equity, but without taking the equity exposure. That's probably one of the number one things we have to explain to people. And we spend quite a bit of time doing that, because again, we understand it inside and out, but we need to educate people so they really understand, like, okay, so we're still in a preserved position. Yes. I'm still getting income. Yes. But you're almost partnering in a sense with the owner without becoming the partner. And that's something that we have to walk people through, and we are always happy to do that. And once they get it, you can see the lights turn on. They're like, oh my gosh, why isn't anybody else doing that? And because that's how the world works we live in. Everybody just does the same thing everybody else does. And that's why we're doing what we do. And it's not new. There are 2 life companies that do what we do. We've represented them. We understand the instrument. We're just taking that institutional sophistication and bringing it down to a 1 to 15 million range.
Excellent. Well, Dave, again, we appreciate the breakdown of bridge loan investing, where this channel is really all about education as well. You're talking about education. Where can folks find more information or educational videos that you've done, or how should they get in contact with you?
Best thing to just start learning is go to hybrid, HYBRID, debt fund. So hybriddebtfund.com is our website. And then you can reach out to me. Just either email dave.cotter@hybriddebtfund, or you can reach me at 602-367-8795, and I'd be happy to talk you through any of this stuff.
Excellent. Well, Dave, We'll go ahead again and put all your contact information below in the comments. Thanks for taking time out. I know you're on vacation with the family. I hope you enjoy your time over there at Lolo May. It's a wonderful place.
Yes.
And thanks a lot, everybody, for tuning in. And we'll look forward to speaking to you next time. Take care now.
Thanks, Doug.
All right, sir. Thank you so much.